Hello everyone, I'm Esteban Burbano and I'm a fixed income strategist here at PIMCO. Today I'm joined by Alfred Murata, Managing Director and one of the lead portfolio managers of PIMCO's Low Duration Income strategy. The Low Duration Income strategy is our flexible global multi-sector strategy that focuses on delivering consistent income while also maintaining a structurally lower exposure to interest rate risk. Alfred, thank you for joining us.
Thank you. Thanks for having me.
So perhaps let's start with a brief overview of the strategy, its main objectives, and how it's currently positioned given the low interest rate environment that we're currently facing.
So in terms of the strategy, what we're trying to do is generate an attractive level of income while trying to potentially protect against the downside. To do this, we're taking advantage of the best ideas in the global opportunity set, which is more than 100 trillion in size, using the resources of PIMCO with more than 200 portfolio managers around the world to come up with ideas to include in the portfolio. Something that we're not focusing on is trying to outperform a benchmark.
And how do you think about the strategy's position in the current environment where we're seeing yields to be very low and also the potential for interest rates to be volatile or even potentially move up given the changes in Fed stance?
Given the relatively low levels of interest rates, we don't believe that investors in many cases are compensated for the interest rate risk today that they may be taking in portfolios. So the low duration income strategy, we think, can be a good complement or a good fit for investors that are concerned about rising interest rates. In addition, we've had significant fiscal and monetary stimulus so far, and that could be removed, particularly the monetary stimulus could be removed. There could be overreaction and interest rates may be increasing over time. Having a low duration focus may potentially protect investors during more challenging or turbulent period in fixed income markets.
And what about the positioning across the credit markets?
So in general, central banks have done a great job at supporting the valuation of these more plain vanilla, more generic assets. So as you mentioned, credit spreads are on the tighter end. That doesn't mean that there aren't some attractive opportunities in the global fixed income universe, which is more than 100 trillion in size. So one area that we continue to find attractive to invest in are non-agency mortgage-backed securities. This asset class wasn't included in, say, the Fed purchase program. And that's an asset class that's trading at wider levels than before the COVID crisis, whereas corporate credit in general is trading at tighter levels. And in terms of fundamentals there have actually been very strong over the past couple of years, where you had significant increase in housing prices, which has led to significant deleveraging of the asset class, whereas in the corporate credit space, many companies have been adding more leverage over the past couple of years. So what we like is the combination of strong fundamentals and also attractive valuations. Corporate credit in general, I'd say, is on the tighter end, but there are some attractive opportunities within corporate credit space. One of them is in financials. Financials have had significant changes in financial regulations since the great financial crisis. Many banks now have tier 1 capital ratios and are focused on safer business lines, such as wealth management rather than proprietary trading. So that's one area that we like the fundamentals. We also see some opportunities in some of the sectors that have been more negatively impacted by COVID, particularly the airlines, but they're focusing on bonds that are senior secured in the capital structure, such as in the airline space, bonds that are backed by either pools of planes or gates and routes that the airline might need to maintain its operations or its frequent flyer program.
Great. And what about in emerging markets? Is that also an area where we are finding some opportunities today?
Yeah, so we think that emerging markets are going to be the center of growth over the secular horizon. That being said, over the past year since the COVID crisis began, emerging markets in general haven't had the financial flexibility to provide significant fiscal stimulus. So I think that's been much more positive for growth in the developed markets compared to the emerging markets so far. But I think that it's important to be very selective and find the opportunities that are going to be more resilient in the event that, say, the COVID crisis takes longer than anticipated. But I think that we're very well positioned within the strategy using the resources of PIMCO to capitalize on these opportunities.
Great. And let's finally just touch a little bit about our overall strategy and how do we manage for the structurally lower duration exposure or interest rate risk exposure versus some of our more flexible strategies?
So with respect to the low duration income strategy, this is a lower interest rate risk strategy, similar to many of the other strategies that we have at PIMCO. But I think the big difference is the focus on generating attractive level of income while trying to potentially protect against the downside, compared to many of the other strategies where the objective is trying to outperform a benchmark. The strategy is a member of the PIMCO income suite, and we're using the same investment process, the same portfolio management team, and trying to take advantage of the best ideas and the global opportunity set to try to achieve the objectives of the consistent income and stability of the net asset value.
Thank you. And of course, we have decades of experience managing for income strategies. So it's a great addition and something that we see many of our clients focusing on.